For a moment yesterday, the euro traded at parity with the U.S. dollar, a one-to-one exchange rate, and it's still only up very slightly from there. At this point, the euro has been obliterated. Almost nobody thinks it can recover. That's a very big deal. A cheap currency makes exports from the Eurozone much less expensive and imports to Europe much more expensive. It can make our goods much less competitive, and it can play havoc with tech service companies, as Bill McDermott, the CEO of ServiceNow, mentioned earlier this week on Mad Money. But is the euro going to stay down here? I don't love betting on currencies directly because these markets are too unpredictable. However, with the dollar front and center as a reason to buy or sell stocks, and with the depressed euro hurting our company's earnings, you can bet I want to know the direction of the European unit. Perhaps I want to know it more than almost anything else. So tonight, we're taking a closer look at the euro with an outside expert. Yep, we're going off the charts with the help of Carley Garner, a brilliant technician who's the co-founder of Carley Trading, the author of Higher Probability Commodity Trading. Even with all the pessimism surrounding the euro right now, she emailed me this week that she thinks it can recover. And I said, oh, come on, really? Show me. So first, let's put this moment in historical perspective. Take a look at the monthly chart of the euro to dollar exchange rate over the last 2 decades. Back in early 2008, when I actually went to Europe foolishly, the euro was trading at $1.60, mostly because the greenback was in the gutter. Nobody thought the dollar had a chance of recovering versus the euro. You started seeing athletes and other celebrities demand to be paid in euros rather than dollars. It's sort of similar to last year when all sorts of people wanted to be paid in Bitcoin, including the new mayor of New York City. Not a great call. Yet, to the surprise of these A-listers, in July of 2008, the euro started to weaken against the dollar, quickly collapsing from $1.60 to $1.23 in 3 months. The currency markets are like that. To borrow a line from my doppelganger, Vlad Lenin, there are decades where nothing happens, and then there are weeks when decades happen. The euro swiftly erased some of its decline, but it's been working its way slowly lower and lower ever since. At this point, $1.60 is obviously distant memory. Instead, the euro spent the bulk of the last 10 years bouncing around between $1.05 and $1.20. Garner notes that the current sell-off is a little unusual. You never see it break down below $1.03. In the big picture, though, she thinks a one-to-one exchange ratio, well, it's probably as unsustainable as this $1.60. That said, with so much traders trying to push the euro down, that's what they're doing. So many traders are actually trying to push it down. She would be surprised if there wasn't one last probe down to crush the remaining bulls before the thing can bottom and start rallying. If so, that might mean that the euro briefly goes to 97.98 versus the greenback, and then bingo. Once the narrative shifts, Garner's predicting a swift rally. Back in 2017, the euro dipped below 105, so let's go on our Wayback Machine, look at that. But within a year, it was back to $1.25. No one thought this move, I remember all these moves, no one thought this was going to occur, and this one, believe me, do you think I booked my trip here betting that I thought that the euro was going to do this, the dollar was going to do that? No. Now, you can see that the euro's currently got a floor of support right near the $1 mark in a saner world where Russia hadn't invaded Ukraine. Garner thinks the selling probably would have dried up at around $1.08. But we don't live in a world like that, right? We don't live in a sane world. Right now, investors all over the globe can't get enough U.S. dollars, which is why the euro to dollar exchange rate is like this. However, as Garner sees it, things are finally starting to normalize in commodities and even bonds, which will eventually flow through to the currency. She points out that the euro has the floor of trendline support right around where its currency is trading. At the same time, the relative strength index, or the RSI, okay, that's an important momentum indicator, is very close to oversold levels. I would argue that it's at oversold levels. Historically, when it gets down here, well, look out above. Selling quickly dries up. Of course, most investors don't want to mess with the currency markets. They prefer stocks, which I think is right. But Garner says people are underestimating the impact of currency fluctuations on the portfolios. Get this. I did not know this. Check out this chart of the S&P 500 futures in green and the euro in blue, going back to late last year. Over the last 180 trading days, Garner notes that the euro and the S&P futures have settled in the same direction 86% of the time. Look at that. There's a very strong correlation, obviously. Assuming it continues, a stronger euro will eventually translate into a stronger U.S. stock market. That makes sense. The higher the euro goes, the more money our companies make doing business over there. And we have a lot of companies, by the way, where we would lift numbers. It is for them to compete with European firms. It's very hard as long as it's where it is. That said, if the euro keeps heading lower, well, you know what? That is bad news for the S&P. But Garner thinks that's unlikely. So let's watch the euro really closely. When you get up in the morning, find out where the euro is. It's probably going to determine a lot of what happens. Next, there's the question of seasonality. Commodities, currencies, and even stock indices have seasonal patterns, annual cycles of feast and famine. That seasonality isn't always decisive. It's just a general trend, but it's always worth watching. Now, get this. When you look at the seasonal pattern, the euro futures from Moore Research Center, Inc., you can see that historically it's displayed a sharp tendency to find a meaningful low in early July. In other words, this is the time of the year when you typically expect the euro to bottom. The subsequent rally often extends to early October. Doesn't necessarily mean that it'll happen again, but it's one more piece of evidence that favors the bulls. Remember, no one's thinking this is... I want to read it. I really got to make this point here. This move would shock people. There's so much money betting against the euro right now. It's just amazing. Now, I want you to take a look at this chart of the euro and the euro C-vol, which is like the CBOE volatility index, but for the particular currency rather than the S&P 500. According to Garner, you'll often see large spikes in volatility when an asset is approaching an inflection point. We've seen this time and again in stocks, commodities, and currencies. For example, a large spike in the VIX often marks the low in the stock market. We saw a similar volatility shock in oil earlier this year on the heels of the Russian invasion of Ukraine. The peak in oil volatility was also the peak in oil itself, at least so far. Why? Because these volatility indices are based on action in the options pits. When traders are willing to pay outrageous amounts for options as a hedge, well, you know what? That's a sign of desperation. Garner thinks we're seeing that in the euro right now. Aside from the March of 2020, when the initial COVID onslaught shut down the entirety of Europe, this is the highest level of implied volatility we've seen in the euro in many, many years. Take a look at that. That's that. And when you see a volatility spike like this, Garner points out that it often concludes with a trend reversal, meaning the market switches direction. Look at what happened in 2018 when we had the big spike, okay? You had the C-vol going down, you had the euro going down, you had the big spike, and then this. In 2020, there was a volatility spike right before the euro bottom. Garner's betting that happens again. Boy, would that be something. The biggest reason she likes the euro here is that everyone else seems so bearish. When everybody's thinking the same thing, the thing that gets priced into the markets and the opposite actually unfolds. Garner's seeing sentiment readings that suggest only 30% of the market participants are friendly to the euro rebound right now. And if you only went by the media, there's even less pessimism. Less optimism. The media's just really just written this thing off. She thinks that means that negativity is already baked in. Plus, it doesn't hurt that the European Central Bank just today said they're paying attention to the impact of exchange rates on inflation. So here's the bottom line. The charts, as interpreted by Carley Garner, suggest that the euro's ready to rebound. If not now, then very soon. And I wouldn't be surprised if she's right, and it helps take the whole stock market up with it. David in Oregon. David.
Yes.
David, you're up.
Okay, is this Jim?
Yes, it is.
Hi, Jim. Thank you for having me. And first of all, I'd like to say that you have been more right than wrong on everything I've looked at.
Oh, thank you, man. That's all you can ask. People who think you can bat 1,000 are just crazy. Don't forget, you can bat 300, you can be in the Hall of Fame. So thank you very much.
Yeah, well, I'm just telling the facts. I've watched Mad Money for years. I've been in the market for 50.
Oh, thank you.
I love it, and I like all your ideas.
You're very kind, and I needed that. You know, sometimes in Twitter, a lot of times people aren't that nice to me. I don't get that.
Well, they get emotional about losing money on their own, and they have to find a boogeyman. Help them.
They find Jimmy Chill. All right, well, let's go to work. What do we got?
Okay, I like Uber, and I've been watching it go down and down, and like everything else, I think it's a great company. If I bought it here, would you recommend that? Let's say that you like it, and I bought it here and sold covered calls against it to protect myself for a while until this market gets straightened out. What do you think?
Well, I'm afraid that you're capping your upside if you do that. I think Uber can still go lower. And the reason I say that is because I don't think the number's going to be that good. And you might want to wait until the next quarter to do some buying. And, David, I really want to thank David from Oregon. I want to thank you. I take a lot of heat. I am in the arena. I come out here every day. But you know what? All I can do, as my late mom would say, is do my best. All right, tonight's chartist, Carley Garner, actually thinks something real crazy, that the euro is ready to rebound. Don't forget tonight. If not now, then very soon. I wouldn't be surprised if she's right, but I think everybody else would be. Hey, much more Mad Money tonight, including my exclusive with Portillo's. Could hot dogs be a red-hot investment for your portfolio? I'm going to check in with the CEO of this regional player that wants to take over the world. Then the Elon Musk Twitter takeover saga, it continues. But from an investment standpoint, could it be a wise decision to view Twitter as a buy at these levels? Let me give you my take. In order to call us rapid fire, tonight's edition of the Lightning Round. So stay with Cramer.
Shepard Smith here. Thanks for watching CNBC on YouTube.